Now, in Unit 13.3, we're going to discuss interest rate options. So, an interest rate option gives its buyer the opportunity to protect the rate of interest payable or receivable on notional loan or deposit for a specified period. By notional loan, we mean that the loan amount will not be exchanged when you're buying the interest rate option. Only the notional loan will be used to calculate the interest amount that will be exchanged. The protection rate is a strike rate under the option. Now we have two types. We have interest rate cap and interest rate floor. Now interest rate cap protects the rate of interest payable on a notional loan from an upward movement in interest rates and thereby guarantees a maximum interest payable. Now, if you think about a borrower, will a borrower be more focused on whether the interest rate will increase or decrease if he has taken out a floating rate loan? What will worry him more? Of course, it will worry him more if the interest rate goes up. So, in that case, the borrower would want to have a cap on the interest rate, which means a maximum level after which the interest rate cannot exceed. So you can see that it says that the interest payable on a notional loan from an upward movement. So you're talking from a borrower's perspective that an interest rate cap would be feasible for him because that would guarantee a maximum interest payable. For example, if the maximum interest payable is set 10%, this is the cap. Now, if the uh, KIBOR goes to 11%, because there is a cap, the maximum interest still paid by this borrower should be 10%. Now, similarly, an interest rate floor protects the rate of interest receivable on a notional deposit from a downward movement in the interest rates and thereby guarantees a minimum. Now you talked about a borrower, now you're going to talk about a lender. So for a lender, if he has a floating rate instrument and investment, what will worry him more, whether when the interest rates go up or when the interest rate goes down? Of course, when the interest rate goes down, because this is an income for him, that would mean that his income is reducing now. So he would want that there is a floor set on this interest rate, meaning that the interest rate should not go below this floor. So for example, if he has set the floor to 5% and the interest rate goes to 4%, he will still receive the 5% interest because he has set a floor and the interest cannot go more down than that. Now let's look at an example. So a corporate has borrowed US dollar 20 million under a 5-year bank term loan. The loan is at floating rate whereby the corporate pays 6-month US dollar LIBOR plus 50 basis points. The corporate treasurer decides to use an interest rate cap to hedge the exposure to rising interest rates that a floating rate borrowing brings. The quotes obtained are as shown. So the US Treasury, because you're talking about a loan, they are the borrower, they want to implement an interest rate cap so that they ensure that their interest cost stays within a limit. Now they have two alternatives, alternative one and alternative two. The currency is US dollar, the notional principal is 20 million, the period is 5 years, it's 6 monthly. The strike rate is 5% in alternative one and it is 5.5% in alternative 2. So this 5% one is actually more better because that would mean that the interest won't even go to 5.5. However, because this is a better alternative, you can see that the premium payable for this option is higher compared to this option. You can even calculate the premium in terms of amount, simply 1.81% multiplied by 20 million. By 20 million, you will get to know that this is the premium payable. You can see that these are quite big amounts. Now, assuming that the investor has decided, sorry, the treasurer has decided that he will go for the greatest protection, namely with a strike price of 5%. He does not even want his interest payment to go to 5.5%. He wants to lock it in at 5%. Let us assume that at the beginning of the third 6-month US dollar LIBOR fixing, that US dollar LIBOR has now risen to 5.5%, and that the rollover period is 182 days. So because it was half yearly, 6 month, it makes 182 days. And because you're talking about US dollar, we have used 360 over here. So this convention should be clear to you. Now over here what has happened is that you had set the cap for 5%, but the interest rate, the LIBOR, has gone up to 5.5%. Now what will happen in this case is that the difference of 0.5, the treasurer is going to receive this amount. So on US dollar 20 million, he is going to receive 5% for this month. So he's going to receive this amount. Now, what is the logic behind this? You will understand this even more by looking at this table. So over here, they have given you LIBOR at 5.5% and LIBOR at 4.75%, and then they have shown you what is the impact. Remember, you have set a cap. Cap is the maximum amount that you have set. So the maximum you have set is 5%. Now, what happens if the LIBOR goes up this cap? It means the LIBOR is 5.5%. The interest rate on the underlying loan that the treasurer needs to pay will also go to 5.5%. Okay, so the person from which the treasurer has borrowed money, he will still have to pay the 5.5% rate to that person. So this is the rate that he will pay over there, but he has a cap. So from whoever he has purchased the cap, so he is going to receive 0.5 from that person. So he will have to pay 5.5 and he will receive 0.5. So the net borrowing cost will be 5%. You need to understand this, that over here, the loan agreement was that he will have to pay LIBOR. So he will still have to pay LIBOR. But because he has an interest rate cap, so there will be an interest rate cap writer. Remember, whenever you're talking about an option, there is a seller of the option who we call a writer. So the other person on the other side will have to pay the 0.5% to the treasurer if it goes above the cap, because the treasurer is going to utilize his option in that case. What happens if the LIBOR is at 4.75? So if it's below the cap, then the cap will not be exercised, because that is good for the company. The company does not have to pay 5%, they now have to pay 4.75%. So in that case, there will be no payment. And as the interest rate goes up even more, for example, if the interest rate goes to 6%, then 1% will be paid under the interest rate cap, will be received by the treasurer, so that the net payment is 5%. Now we're going to discuss another concept which is called interest rate collars. So it should be clear that one of the principal attractions of using options to manage interest rate risk is the flexibility of the instrument. So options always are flexible because they give you the right but not the obligation to use them. So when the interest rates were below the cap, when they were 4.75%, the option was not used. One of the problems the treasurer faces using interest rate options is that board of directors or finance directors often react negatively to the absolute amount of the premium payable. Remember, the premium payable was quite high. It was $462,000. So for this, this is too great a price to pay for protection. So there is actually a way that you can reduce the amount of premium that you will have to pay, and that is done through an interest rate collar. Banks selling options to corporates have therefore developed structures that, while trying to keep some of the flexibility of an option, reduce the upfront premium. How do they do that? They do it through an interest rate collar. The corporate wishing to obtain a protection against rising interest rates. So if he is going to buy an interest rate cap, he will do one more thing to reduce the premium, and that would be to sell an interest rate floor. Okay, now both of them are different. Over here, you are buying an interest rate cap, and over here, you are selling an interest rate floor. If you're selling, that means you will become a writer. Then you will no longer have an option. You will be obligated by the person who has purchased the option. So whatever decision that person takes, you will have to go with it. Over here, you will have to pay the premium because you are buying it. Over here, you will receive the premium because you are selling it. So if interest rates fell below the strike rate in the floor, the corporate gives up all further gains. So the disadvantage of this is that now if the interest rates go down, you won't be able to take benefit from that. And we will discuss this why. Sometimes collars are structured to reduce the premium payable to actually zero, in which case the premium receivable from the selling the floor exactly offsets the premium payable on the cap. Now let's look at an example to understand this even more. So the example 1 and example 2 you have over here. So over here the information is the same, but over here you can see that the strike rate under the cap is now 5.5% for both cases. And the strike rate under the floor is 4.5% in this case and 4% in the other case. In the strike rate under the floor that is a bit higher, you can see that the premium payable is even lower. And the one that has more difference, actually, the premium payable is a bit higher, but you can see it's reduced to almost zero. So 0.2 and 0.68%. The more you take the strike rate under the floor higher, the lower this premium amount will go. Now, let's see what happens at the different LIBOR rates. So now what is your scenario is that you have set a cap of 5.5%. Also, you have set a floor of 4.5%. So we have selected the 4.5% one. Now, what happens if the LIBOR is at 6%? If the LIBOR is at 6%, it means it's above the cap. So in this case, the cap is going to get activated and nothing will happen to the floor. So what happens now is that the cap has been activated. Now you have to pay 6% from the person that you have borrowed money. So you will have to pay 6% under your underlying loan. That is the same. But because you have an interest rate cap, the difference of 0.5% you will receive. You can see that the receivable is in bracket. This does not mean that this is negative. This is actually positive because that means that you are receiving money over here. So you're going to receive 0.5%. So your net borrowing cost will be 5.5%. This is the same thing that we have discussed even before. Now, what happens if the LIBOR is at 4.75%? It is in between the cap and the floor. If that is the case, then nothing will happen. Neither the cap, neither the floor will be activated because there is no need for it. You will simply pay 4.75% on the interest rate loan that you have taken out. Now, what happens if the LIBOR actually goes to 4%? Now it is below the floor. Once it's below the floor will get activated now. And how will the floor get activated? First, you need to understand that on the loan, you will pay 4% because that is the LIBOR. But you cannot enjoy this 4% because you have sold a floor. Now, because you have sold a floor, you will have to pay over here the difference of 0.5%. So you will have to pay the 0.5% and your net cost will go back to 4.5%. So you will always stay in this range. Either you will have to pay 5.5% or 4.5%, or you will be in between. So this is like a range has been created and you will stay in this range. You cannot go below this. So you cannot take advantage of the lower interest rate anymore. And neither will your interest rate go up. This is exactly like an interest rate collar works. So you are in between. This is the cap and this is the floor. If you go below this, if the interest rate goes below this, then you will have to pay under the floor, due to which you will go back to the floor rate. And similarly, if the interest rate goes up, then you will receive under the cap.